Welcome to Launchbase, a fast-paced podcast exploring the latest in tech funding and product launches. In under 30 minutes, we break down key trends, interview industry leaders, and uncover what's driving the next wave of innovation. And now your host, John Radford.
Hello, and welcome to another episode of Launchbase. This is the podcast that dives into all things tech and business in under 30 minutes. So I'm your host, John Radford, and each week I chat with individuals shaping the tech landscape. So today I am joined by Tony Kula, a seasoned entrepreneur and active angel investor based in Berlin. Tony's the founder also of Meet2You and has led the company to becoming a leading provider of virtual events and digital communications. Beyond his entrepreneurial ventures, Tony is deeply involved in the startup ecosystem, focusing his investments on early-stage B2B SaaS startups with traction. So today, we're lucky to have someone with a dual perspective as both a founder and investor. And so we're going to kind of dive straight into that. We'll look at kind of the factors of early-stage B2B investing, startups, the whole works. So let's get into it. Tony, good to have you on the show.
Thanks, John. Thanks for inviting me.
Pleasure, mate. So how was that introduction? Perhaps you can kind of expand on that, fill in any blanks that I might have left out.
I'm a pretty old guy, so I'm not going back to the roots.
Yep, fine. Go back as far as you want.
Yeah, I mean, let's focus on the last years. I think that is what's interesting is the angel investing. So I finished my career as an operator. You never know, I might go back, but that was in 23 after quite a roller coaster with Meet2You during the pandemic. We've been in digital events, which went really up and then bounced back. So that was my latest adventure, but it was my first company. I was an entrepreneur basically all my life. So, I had a certain age, 50 plus, I decided, so I want to change sides and give back a little bit. And at the beginning of 23, then I embarked on this journey as an angel investor and currently did 17 investments, mostly direct. There are also I'm an LP in 4 VC funds.
Amazing. Where typically your investments located across Europe or United States as well?
It's mainly Europe, yes. I have one that is in the US, so I was also betting once on a Y Combinator founder. I think you want to have some very expensive investment in your portfolio. And I did that, but I really like the guy.
I've got a couple of things there that I need to pick up on straight away. You said I'm betting. So is it a bet as an angel investor? Is that basically what it is?
To be honest, I mean, I haven't really figured out what I've been discussing that with other angels. I think which have much more investment. I think we came to the conclusion it's probably more art and science. And so I think betting is not maybe the best thing, but it's also not totally untrue. So
Sure.
Yeah.
Yeah.
Of course, you have to see that the time that you do the investment and the outcome is so delayed.
Yeah.
If there is an outcome.
Yeah.
So it's really a long term.
If as well. But there's another one I want to go back to is that you said you liked the guy. Now, that's for me is super important. And with all the angel investors and any investors, in fact, across the spectrum, until you start getting to maybe Series A and B, is a lot of it just comes down to the person and what makes them investable. Would that be fair to say?
That's totally fair to say. It's of course in early stage, it's all about the founder.
Yep.
From my experience from the last 2 years. So I really, this is what you have. There's not much data in early stage. So you look at the founder profile. Of course, it makes a difference. Is it a first time founder? Is it someone that had an exit before? And you're looking at, basically you try to find signals not to invest, but sometimes you see they're checking all the boxes. There's the chemistry is right. There's this, we talk about this a lot on LinkedIn, founder investor fit. There must be this personal match somehow, and you look at their background, and still you don't know if that is going to be a success. But for me at least, I want to see a little bit of traction, not only a nice polished pitch deck, but first revenues, first customer, first pilots, first projects. A little bit of MRR is important to me in order to move forward. But in the end, it's all about, at that stage, it's about the founder.
Yeah, and so you need to see some early traction, and that's totally fair. But then founders playing a sort of chicken and egg scenario, saying, "Well, I need money to get a product to build something to then go and get traction. What do you say to that? Or is it kind of is no code tools and AI based coding kind of removing that obstacle now and making it easier for founders to get started? Or what are you seeing?
There are like two fractions of these. So I burned my fingers with that because some would come to you and say, yeah, but bootstrapping, that is like that is like really a privilege. And of course, you to be fair, you must say there's a difference. Are you like a 20-year-old guy that is just hanging around with his mates and doing that without having any responsibility, without or living with the parents and having no kids? Or is that someone that has duties and a loan to pay and a family to feed and all that? So there's certainly a difference. So every story is different. I started like this, so that's, I advocate for bootstrapping. I think it became much easier today because you don't need to invest much to have a tech team and all that. So you can probably much easier validate your idea and see if that somehow works and find the first customers. And of course, it's also depending on the space that you're acting. So if it's deep tech, I mean, the guys that launched in Germany were proud of that. The rocket, so you can't do that without funding. I mean,
No, you can't.
there's no product, there's no revenue, there's nothing. So I appreciate deep tech and other industries. They need to survive somehow the first years. But in SaaS software, I think you can go pretty lean. And I mean, there's also bootstrapping and bootstrapping. Some call it now seed strapping. But what I like is to call it like you can go with a really like a minimal funding approach. So you don't need massive amounts of money. You don't have to go with a VC. You can try to get a loan or a grant or whatever, a little bit friends and family. And since the time became so short and you do crazy things with AI. I mean, you can do your not only the product itself, but also the marketing and everything. So you can accelerate tremendously and you can build with a very small team. You can at least start like this. And I would always advise to consider raising only when you know there is potential to scale. And I know what I'm playing here. I know that I give away a part of my freedom with not only the equity, but there are other. So that money, VC money, comes with a price. It's
Yes.
not free.
Yeah, absolutely. And then that's a lot of people see the kind of, well, moving ahead to sort of the VC side of things is like that's like the end game, but in fact that's just the start. You know, you take that VC money and then that's when shit gets real, right?
Yeah. No, that is just a step on the journey, and it's just one path. So it's like for me, and I think this comes also back to this generation of founders. It's like becoming fast profitable, generating positive cash flows and all that. It's something that's a real game changer. So
Yeah.
just trying to get money from someone is one option, but it's not the scope of running a business.
Yeah. Right. And so your kind of focus is on B2B SaaS, is that correct?
Yeah.
And why specifically B2B SaaS? What is it about that
That is
you?
my background. So I also in enterprise, I focus on enterprise and that type of services and software, or I was like more in tech-enabled services. I like the repeatable notion about it. I like that you don't have to acquire the customer. I come from a hardware background. With my first company, we're selling huge video conferencing stuff. So that was like really a business that was like with a lot of capex and quarter by quarter. So I always liked things. And when I started my conferencing services before the virtual events businesses, it was nice because you just need to it was a type of SaaS. You need to get the customer once. And if you don't screw it up, you always had him and you can expand. And it's the same thing because the biggest effort in the business is to win customers. So getting them on a monthly basis is like something that is very nice. And if you can expand it, and yeah, that's my background, and this is why I focus on that. I understand that, but I also try to look at larger ACVs, larger companies. So this is also where
Cool. And so at this angel stage, what's the ask from a startup typically?
in terms of money,
Yeah.
some were just starting at 25. I think that came down a little bit. So my sweet spot is around 50K checks. I did some bigger ones. But I've also realized that it's important that you diversify your portfolio. So I would rather recommend not to place 100K in one, but rather have two at 50 or even four at 25. And maybe if there's more conviction along the way, just to put in another check to just not getting diluted if they're getting around. Or I mean, that depends. But yeah, this is what I typically see. But then you have like all these other sort of funding or like angel clubs where they have this SPV structure where people can just chip in 5K, 10K, and they're all pooled in a way. But I only do direct.
And typically, what do you see as a pattern of what the founders need the money for? Where's the money going?
Yeah, I try to. I mean, we
Because you've
always
got this
try.
kind of a lot of these debates about when founders start paying themselves salary and how much goes into product, how much goes into marketing, all of these things. It's difficult to kind of slice up. It'd be interesting to know how it gets diced up.
Yeah, I mean, John, you're part of this this crazy scene. They have always in the pitch deck. There's always this like this slide where they say, okay, 23% goes to marketing and 34. For me, it's more important to understand are they capital efficient. If they're taking like 500, 600, 800K from angels, what does that mean in MRR? Where does it take them? So if they're like at 10K, would that take them to 60 or to 600K ARR? So this is the metric that I understand. I want to understand as an investor, how do you put my money to work? So because the other thing for me is more like really glass ball and totally fiction, because you don't know what happens on the way, how much you will exactly spend on marketing and all these things. So I think it's more relatable to try to set a financial goal and say, okay, so with that money, we're trying, and then I'm also not trying to get too operational involved into the startup. So they have to decide, do they need two SDRs, three, one, or one SDR plus an account executive? So it's their decision. So we try to like eyes on, hands off, and if they're asking for advice, so as active angels, I think it's fair to share an opinion, but every business is so different. So I went away from like getting too close to, into operations.
Cool. So let's talk about startups that you've invested in previously. And maybe you could pick out one or two and talk about why specifically you invested in those and what drew you to them. What was the kind of, yeah, those guys or that business or that
It was
person?
always the people.
Really?
Yeah, it was always the people. So it was like, I mean, of course, it starts with the outreach. So that should be not like, I don't know, like people, they just spray and pray and it's totally unpersonal and not related. So I think it's important that you really target, and it's like, and you see a lot of what's going on in their minds. And there's also the perception how they do this. It's maybe also how they treat customers and everything. And if that is polite and in a nice way, but not like a big novel. So also like coming to the point and showing good signals. And you always try to look for that signals. And then you go into the first meeting. And if there is like this click, and then you start going deeper into the data and try to understand their solution. And you always need to see something. But yeah, that's how it started for me. It's really about the founder.
That's so interesting. I know, but I always say that for me, the most important skill of a founder is the ability to sell, and not just sell your business, but sell yourself. And I guess that kind of
That's the same thing.
yeah,
So
yeah,
they
because you
sell,
are the business, I
they
guess.
sell their vision, they sell a part of their company. And so, and this is for me also how I perceive they're going to treat customers, how they're going to sell with customers. Can they do that? And I don't know if that is the best investment approach, but since it is so early, even if they have data rooms, they don't have much history. There's not much you can look at. So it's like really I tried not, I mean, I did that too. Like I was committing directly during the first call. I really felt like it was love at first sight in a way, but normally I try to sleep over it. I also look a little bit, who do they have a lead investor? Are there people from their industry if it's not exactly what I'm used to? And I try to speak with other angels and how it's good to look from different angles on the startup. And you probably have a second call, a third call. Some you go back and say, okay, let's talk like in a little bit later with a bit more data, or when you have brought that deal in or something. So you also see, you try to see, is there someone that is coachable? Do they listen, or
Yeah.
are there? It's like it's a very much, for me, it's very much like a people play. This is also where I think angels can provide real value, is if there's this investor founder fit, or
That's the
founder
founder fit.
investor fit.
I love that one because we talk about founder market fit and all of these things. Investor founder fit is not something
If
that's
you're
talked
taking
about that
external
much.
money, but because it's maybe not like a marriage, but it's long.
It is, yeah. Yeah. It's
Stay
not going to be
together.
like
So
a
I have
6 month. So actually, in terms of time frame, from a successful outreach whereby there's someone's piqued your interest and you have a call through to receiving a check, what is a typical time frame for something like that?
very difficult, but for me, since I invest my own money, and there's also there's a bit of FOMO, and you always look who else invested, and how does the founder play, does he place that right and everything, and do I really get excited, and that really goes fast. So I never take decisions for weeks and months, because I don't have I'm not doing due diligence like a VC, and I just have to, I try to sleep over it. I look at it, and I speak to some others, and if I like it, so most of the time it goes pretty fast.
Yeah. Well, that's encouraging to hear. But I guess the ones that are taking a long time, it's because they've got problems in their fundraising process. So I want to talk about some of the problems that you see and some of the kind of common mistakes, the ones that creep up often. And you go, oh, don't do that. Stop it.
On the founder side,
Yeah. What do they do? What are these things? If you see your founders, you must, the ones that you kind of go, no, thank you. Are there mistakes that they're making beyond like the personal side of things? Other than spamming people using some kind of AI automation to spam people, that's obviously not going to
yeah,
work.
that
We
is
know
the
that.
worst, but they drop out at the very beginning. I
Yeah.
think that is to create like fake urgency,
Okay.
or
Nice.
not being authentic, and telling I have soft commitments, or I don't know. I appreciate more to say, okay, look, this is we haven't figured out completely our go to market, but so to be totally honest, to have build trust, and not to create something. If you're, I mean, if you're not Sam Altman, and you're just a first time founder, you're a first time founder. It doesn't have to invent stories. Um, I like that more, and I think this is what some try to. I don't know, but yeah, just be yourself, tell your story. Um, of course, I see there's a lot of people. They are like they're very in love with their product. We always try to see, will that people. Will that person be able to sell if they're like, you try to read a little bit in this personality. It's not easy, but yeah, I think some try to oversell. I don't know. It's very hard. I always try to say, like, human to human, be yourself. I'm a normal guy. I built my business. Let's just speak, and see how where that leads, and try to
Yeah.
take away also that type of pressure.
Yeah, I like the authenticity part actually, because like you say, there can be a temptation to kind of go, oh, I worked for 10 years at so and so company and did all of this, when
Yeah,
some of it's probably not even true.
and X this and X that, and then okay, but this, yeah.
Right. Yeah. No, that's interesting. So beyond the capital, the angel investors, what kind of role would you typically play, beyond just capital? Is there an active role, or are you more passive, or
Super depending on the startup. So I have a few in the portfolio where I really very closed, and I have like weekly calls. I have some others that I start to nurture. I was in the beginning, so because I came out of this from a full operational role, and I was seeing them doing their mistakes, and wanted to jump in, and I had to hold back, and say, okay, look, that's their company. So I just own a very small stake. I think I even don't call it advice. So I share my opinion. I try to protect them from failure, but they happen. They have to happen. They happen to all of us that have been through that. And I think you should always offer what they can and want to get. So it's not like this unsolicited advice. And I don't know, I did it like this 20 years ago, which is like totally irrelevant for
It's
them.
not
So
relevant.
it's
Yeah.
like, I think most of the angels, ex-operators have seen a lot. And if you see that there's someone that is struggling, so it's like more encouraging. And I have others, I just see the once a month report and they're doing on their own. You also don't want to be like their nurse or like
Sure.
helping them all the time. So then you also have a problem because they need to be able to run
You've
their
got to
business
figure it
on
out.
their own. So it's just, if they need help, if they need a contact, if they ask, would you do that? How would you deal with that situation? This is when we speak. So, but it's very different across the portfolio.
Sure. But as an angel, if you see someone going off down a wrong path, do you step in, or do you kind of leave them to it, let them figure it out?
It really depends. I mean, if it's a very critical situation, I would jump in, of course. It happens, but if it's like things that are existential, where you say, okay, look, this is rather a short runway, I would start cutting costs and not like saying like, hope it's not a strategy. It's time to act. You won't get that money. It's difficult to raise at that moment, so you better act now and not. I see many, they're just very deep into their thing, so I did the same thing, exactly the same thing in my career. So they're procrastinating difficult decisions. And I rather say, I think it would be good to act now.
And why is that? You get too involved in the product itself rather than looking at the big picture?
Yeah. They hope next month things are going to be better, but they're not changing
Sure.
so much. So it's like, or they're just too much in details, or like trying to fix the product. And it's most of the time it's like their sales issues. I mean, they're not having enough prospects in the funnel and all these things. So where should that come? But still some hope.
Yeah.
Time is running fast, and I know that from myself. So.
There's not much that can't be fixed by sales, essentially, is there?
Exactly.
Yeah, and so just like raising angel money to then go straight and raise again and raise again and raise again is just kind of pouring water into a leaky bucket. Essentially, you still need that kind of sales engine because the money is there to.
It doesn't make sense to raise more, and you won't be able to raise more if it's like everyone looks like, oh, that's a bridge round. I mean, you can do it maybe once, and most angels know and support their founders. But if you see it's like a repeated pattern, and it's just like the sunk cost fallacy, you at some stage you just lose belief. And it's not like money is not healing the problem, it's just delaying it and giving it a little bit more runway. That is then already a critical stage. So things can take longer. Most of the startups that I see, they underestimate, because we always hear the success stories on LinkedIn, how fast they get to 2 million ARR, but this is not the normal case. And you don't know how much money was poured into those startups. Some do it also on their own, to be fair, but most startups really need more time than they think they do to figure things out.
Yeah, absolutely. And money is not healing the problem. That's a good one. Learn sales, guys. Let's have just one last little takeaway before we wrap things up. Any kind of reflections or lessons from your investment journey that you can share with everybody?
Well, it's, two things. So for others, I think if you have the possibility and you can afford some money, angel investing is like a nice thing. So I really loved it because it keeps me in the game, and I like that exchange. I like this. It's like also like you see so many different things. So I can recommend it from a founder side. I don't know. For me, being a founder all my life and dropping out of university, it's like the most rewarding journey. I would do it all over again with all the mistakes and all the problems that happened and all the shit that was on my way. But for me, it's what comes closest to having and reaching some kind of personal freedom. Thank God it was okay. And I would also give the advice not to look so much and compare myself with others, how fast they went there and how big was the exit and this and this. So it's like you define your own pace, and you should only compare yourself with where did I stand 2 years ago, but not with how much does he have and how fast did she go and all this sort of things.
This is a super interesting chat, Tony. I really appreciate your time. Guys, if you enjoyed this episode, please do like and subscribe for more kind of tips on scaling your SaaS products. Tony, thank you for your time, mate.
Thank you, John. Bye-bye.
Cheers. Bye-bye.
Thanks for tuning in to Launchbase. If you enjoyed this episode, don't forget to subscribe and share. Stay tuned for more insights on tech, funding, and product launches. See you next time.